Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, this is exactly what we saw during the Great Depression, and we're seeing it occur right now, specifically in one nation, but the conditions are present all around the world, and have no doubt the rest of the world is going to follow suit very quickly. So what nation am I talking about? Well, I'm talking about China, which is in the midst of a deflationary spiral akin to the Great Depression right now. And have no doubt the rest of the world is going to be in the grips of that deflationary spiral sooner rather than later. It's just a matter of time. So what am I talking about? Let's first look at what happened during the Great Depression, what some of those conditions were that we saw then, and then we can relate that to what we're seeing today, right now, in China, as well as the United States and other nations. But again, the rest of those nations will follow suit very quickly. So let's start with this right here. This is from the History Channel, history.com, Great Depression history. The Great Depression was the worst economic downturn in the history of the industrialized world, lasting from the stock market crash of 1929 to 1939. As we talked about on this channel, something just as bad is coming, but it won't last that long. It's not going to last 10 years. It might last 2. And the reason is because the government response is going to be overwhelming, and it's actually going to create another different financial crisis when they do that. And of course, they'll roll out as the solution to these multiple crises they've created. Their solution will be, well, you need central bank digital currency and tokenized assets and a digital ID, and all of the things we talked about in Friday's video that are going to make you a prisoner in their global system. But let's see what they said here. It says the Great Depression was the worst economic crisis in modern history, lasting from 1929 until the beginning of World War I in 1939. The causes of the Great Depression, and people debate those, but let's see what conditions they're citing here. It says the causes of the Great Depression included slowing consumer demand. Well, we're seeing that. Mounting consumer debt. We've definitely seen that. And I believe that plays into the slowing consumer demand. Once you've taken on so much debt, you can barely survive. You're not going to be increasing your consumption. Decreased industrial production. We're seeing that. And the rapid and reckless expansion of the U.S. stock market. Right now, we're at an overvaluation of the stock market based on the Buffett indicator that's just below the all-time high probably, I don't know, a week ago. But it's higher than it was in 1929, higher than the dot-com bubble, higher than right before the great financial crisis. So we're at all-time bubbles in the U.S. market, but markets all over the world. When the stock market crashed in October 1929, it triggered a crisis in the international economy. A rash of bank failures followed in 1930. And as the Dust Bowl increased the number of farm foreclosures, unemployment topped 20% by 1933. So we see these conditions in the economy, an over-indebtedness, peak indebtedness. We get to a point where individuals, corporations, and governments take on so much debt they can't possibly take on any more. And then they start defaulting on that debt, which shrinks the currency supply, which is the definition of deflation. We often see in the mainstream news, they equate inflation with rising prices and deflation with decreasing prices, but that's not really what the definition is. It's the currency supply. Is it shrinking or is it expanding? If it's expanding, that's inflation. If it's decreasing, that's deflation. Oftentimes, prices follow those things, but there are other factors that contribute to prices as well. But when you have so much debt that it can't be paid off, it doesn't get paid off, and then it gets defaulted on. That shrinks the currency supply and creates this deflation, which then we'll talk about a little bit more in a minute, just feeds on itself and sends everything downward. But let's see what else we can learn about the Great Depression we have. This is from encyclopedia.com. Because what did we just talk about? All that led into banking panics. What it says here, banking panics. 1930 to 1933, more than 9,000 banks failed in the United States. Between 1930 and 1933, equal to some 30% of the total number of banks in existence at the end of 1929. And we read this in Britannica, The Causes of the Decline of the Great Depression. And let's see what they have to say about banks as well, down here in Banking Panics and Monetary Contraction. Because again, deflation is a declining currency supply, whereas inflation is an increasing monetary supply. So for instance, in the United States and many other countries around the world following the pandemic, they massively increased the currency supply, and what followed shortly thereafter was increases in consumer prices, because you had more currency chasing the same number of goods, and in many cases fewer number of goods, because of the pandemic shutdowns led to supply chain issues. So that led to an increase in prices. But the root cause of that is the currency creation, an expanding number of currency units pursuing the same number of goods and services. So this says, the next blow to aggregate demand occurred in the fall of 1930. So again, we read in that history piece, it started with these slowdown in consumer spending, increases in consumer debt, lower industrial production, and then the bank failures began. So keep in mind, we're going to see that same pattern take place today, in our day and time, and we'll look in a minute. It is happening and has happened in China. So it says the next blow to aggregate demand occurred in the fall of 1930, when the first of 4 waves of banking panics gripped the United States. A banking panic arises when many depositors simultaneously lose confidence in the solvency of banks and demand that their bank deposits be paid to them in cash. Banks, which typically hold only a fraction of deposits as cash reserves, must liquidate loans in order to raise the required cash. So this is what we saw happen with Silicon Valley Bank last year. They had a run on the bank. Depositors came to take out cash. They had a whole bunch of government bonds that they had purchased that were no longer worth what they had the purchase price they paid because of rising interest rates. So they were forced to sell those. They were fine in theory until they were forced to sell those. But once they were forced to sell those, they had to sell them at a loss, and it doomed the bank. So this process of hasty liquidation can cause even a previously solvent bank to fail. The United States experienced widespread banking panics in the fall of 1930, the spring of 1931, the fall of 1931, and the fall of 1932. The final wave of panics continued through the winter of 1933 and culminated with the national bank holiday declared by President Franklin D. Roosevelt on March 6, 1933. The bank holiday closed all banks, and they were permitted to reopen only after being deemed solvent by government inspectors. The panics took a severe toll on the American banking system. By 1933, 1/5 of the banks in existence at the start of 1930 had failed. And we just read earlier, they said 30% of those around at 1929 had failed. So The stats may be somewhere in the middle, but it was a good chunk of the banks. And when you have those bank failures and people, that cash is gone, and that shrinks the currency supply because they've effectively defaulted on their debt to the depositor. And when you have these defaults, it leads to deflation. It says, by their nature, banking panics are largely irrational, inexplicable events. So they're saying, it's totally irrational. Who could explain it, right? Well, let's go back up to the paragraph we just read where they said, a banking panic arises when depositors simultaneously lose confidence in the solvency of banks and demand the bank deposits be paid to them in cash. So I don't think it's irrational or inexplicable. If you think the bank is going to fail and you have cash in the bank, is it irrational to go, I think I'll take the cash out before the bank fails? It's not irrational at all. It's also not inexplicable because, well, if the bank's on the verge of failure, it would really be inexplicable and irrational if everybody didn't show up at the door at the bank and say, give me my cash. So I'm not sure what they mean by this. It says, but some of the factors contributing to the problem can be explained. Economic historians believe that substantial increases in farm debt in the 1920s, together with U.S. policies that had encouraged small, undiversified banks, created an environment in which such panics could ignite and spread. The heavy farm debt stemmed in part from the high prices of agricultural goods during World War I, which had spurred extensive borrowing by American farmers wishing to increase production by investing in land and machinery. The decline in farm commodity prices following the war made it difficult for farmers to keep up with their loan payments. Now, some of this is true, but that's not what happened, because World War I ended in 1918. They're talking about bank failures and panics in the 1930s. So what happened was the Federal Reserve, the creation of the Federal Reserve Bank in 1913 completely changed the monetary system, and they extended credit that otherwise wouldn't have been extended in the past. And that easy credit led to bubbles. It led to increased debt levels among consumers and businesses. It led them to take on debt they otherwise wouldn't take, led to a bubble in farmland prices. You saw a miniature bubble in the 1920s in Florida real estate. You saw a bubble in the stock market as people took on loans and bought on what they call on margin, which is basically taking a loan to buy stocks. And so the commodity prices really didn't collapse until after the Depression started and people were cutting back on their consumer spending. Those commodity prices dropped. That's when you started to see people lose the farms because they had extended themselves. The 1920s had been so good, they thought, well, this will never end. I need to buy as many farms as I can. This is great. And so they took on debt load they otherwise wouldn't take on because times seemed so good as a result of the easy, loose credit policies of the Federal Reserve Bank. Sound familiar? In our day and age, we had people buying what they call non-fungible tokens, which are basically little image artworks on the internet, and Dogecoin and all of these cryptocurrencies and meme stocks and GameStop stock, all of this stuff, and creating bubbles. Real estate, we see all of those things today. When the bubble pops, people start defaulting on that debt. That creates deflation. So let's read on. It says here, the panics caused a dramatic rise in the amount of currency people wish to hold relative to their bank deposits. The rise in the currency to deposit ratio was a key reason why the money supply, we'll call it the currency supply in the United States, declined 31%. So that's from 1929 to 1933. That's a huge deflationary contraction of the currency supply. 31% of the dollars that had been in existence in 1929 disappeared by 1933. This is why when you hear stories of the Great Depression, people will say nobody had any money. Money was so hard to come by. Well, because a third of it that had been in existence before simply disappeared. And I'm going to argue with this in just a second, but it says in addition to allowing the panics to reduce the U.S. money supply, the Federal Reserve also deliberately contracted the currency supply by raising interest rates in September 1931, when Britain was forced off the gold standard and investors feared the United States would devalue as well, which they did in 1933, when by executive order, FDR ordered that all gold be turned in, and then they changed the rate from around $20 to $35, I believe it was. So that was a massive devaluation. All that happened. The panics and the decline in the currency supply wasn't because they're trying to basically say, here, people stuffed cash under the mattress, and that shrunk the currency supply. That's not what happened. What happens is, and we see this today, we have this debt-based monetary system where the currency supply is increased when people take out debt, when they take out loans to buy a house, loans to buy a car, loans to buy a boat, loans to buy a business, commercial real estate, whatever it may be. It requires an ever-increasing amount of debt in order to prevent the system from imploding. And that's why we see constant upward trend in debt levels, whether it's the government, local governments, individuals, companies, constantly taking on all of this debt. And what happens is when you get to a point where that debt is so large that no more can be taken on, people can't take on any more, then they don't. And then people start to default on debt. And when they default on that debt, it shrinks the currency supply. It takes those dollars out of existence, or that cash, depending on what your economy in, goes out of existence. And then what that leads to is everybody's scurrying around because they have their debts they've got to pay back, and money's so hard to come by, right? So as people start to cut back on their spending, it bankrupts companies that are dependent on that consumer spending. And then those companies lay off their workers. And then those workers can no longer afford to spend as they had in the past, and they can't afford to service their debts, so they go bankrupt. And it creates this cascade of corporate and individual bankruptcies that spirals downward. And so that's what we're seeing in China right now. It's what we saw during the Great Depression. So let's look at what's going on in China right now. So this is from CNN Business. It's from, I believe, in June. Let's see if they've got, yes, June 17th is when this came out. It said, prices of new homes in China suffered their biggest fall in nearly a decade last month, in a sign that Beijing's historic real estate rescue has not yet revived demand. Prices in 70 major cities were down 0.7% in May from April. National Bureau of Statistics figures showed on Monday. That's the steepest month-on-month drop since October 2014. According to separate calculations by the Macquarie Group, prices of existing homes in those cities fell by 7.5% year over year last month, marking the biggest decline on record. So let's go down again to the bottom of the story where the good stuff usually is. And we read, the threat of deflation continues to haunt the world's second largest economy as domestic demand remains weak. The consumer price index inched up just 0.3% in May, unchanged from April, according to MBS last week. That was slightly below expectations. Producer prices dropped 1.4%, down for a 20th consecutive month. So again, deflation is not declining prices. The reason these prices are going down is because there's no consumer demand. And so the production, things that have already been produced, they're putting them on sale, hoping somebody will buy it. Meanwhile, they're cutting back on new production. Those are some of the things we just read in that history.com piece about lowered consumer demand, increased indebtedness, lower industrial production, and then shortly thereafter come the bank failures. So here's what else we're reading about in China. This is from ESSA News. China's banking turmoil. 40 banks vanish as crisis deepens. It says the Chinese banking sector is facing a severe crisis. In just 1 week, 40 banks disappeared, and the collapse of Jiangxi Bank has further deepened the sector's problems. Experts warn that the situation could have severe consequences for the global economy. Reports from China indicate the collapse of one of the banks. The portal renminbio.com published a report from outside the headquarters of Jiangxi Bank, which concerned clients stormed over bankruptcy rumors. Well, another way to state that is there was a bank run, right? One of those inexplicable, irrational bank runs, right? The bank had previously informed that its profits could drop by 30% due to customers' loan repayment issues. So people probably heard that news and thought, should I take my cash out of that bank? Totally irrational, inexplicable, nobody knows why, right? But that's what happens with these things. It says The Economist described the situation in the Chinese banking market. It was noted that approximately 3,800 banking institutions were threatened in China. Their assets are $7.5 trillion, representing 13% of the country's banking system. So what did we read about? We just read about in the Great Depression from 1929 to 1933, we saw a 31% decline in the currency supply in the United States. If these banks fail, we would expect to see a corresponding decline in Chinese currency supply of 13%. And that's if it's just these banks that are the problem banks, because what happens once you see bank failures start to cascade, then all of a sudden people realize, well, I thought that bank was fine. I didn't realize they were owed cash by those banks that just failed over there. So now they're in trouble too. And you have contagion through the system. And if you read down to the bottom of this, which we won't hear, but last year, the Chinese government put out a report and said 98.8% of all Chinese banks are in fantastic shape, right? or not of the banks, of the assets, the banks that held the assets. So, and now here we're reading The Economist is saying, well, 13% of them are in a whole lot of trouble. So, the government lied. We see a lot of that stuff. We see a lot of these analysts that make these rosy predictions and they say everything's fine, and then you find out it wasn't. Oftentimes that's a matter of groupthink, where if you go out on a limb as an analyst and you say, guys, there's huge problems here, we should sell all of these banks, they're about to collapse, and then it doesn't happen within a few months, then you get fired, right? It doesn't matter that it happens 2 years later, just as you said it did, they'll fire you. So it's safer for these analysts to just go along with the crowd and say, yeah, I agree with the crowd. And then when they're wrong, they say, well, I was wrong along with everybody else, and nobody gets fired. That's how these types of bad analysis just continues to proliferate. It says the magazine emphasizes that these banks have long been poorly managed and have accumulated vast amounts of bad loans. The report states that many of them lent money to developers and local governments, exposing themselves to the impacts of the real estate market crisis. The authors note that in recent years, some banks have revealed that 40% of their portfolios are non-performing loans. The rare disclosure of a bank's problems may underscore the seriousness of the situation. A similar mechanism was observed with developer companies. Little was heard about the giants' problems until the authorities eventually confirmed an issue affecting the entire industry. So what happened, you had these Chinese property developers out there, and they would say, well, we're going to build this huge apartment building. And a lot of Chinese citizens, they invested their retirement in property. And so they said, well, we'll give you a cash advance on one of those apartments, and we'll own it when it's built, and that'll be our retirement nest egg. And then they found out, well, the developer stopped the building process, didn't refund their money, went bankrupt. So now all of those people that thought they owned property were just out the money that the cash they put up to begin with. So let's see what else this has to say. This is from Bloomberg within Yahoo Finance. It says, China consumer prices inch up, but deflation pressure lingers. It says China's consumer prices eked out another small gain in June, hovering near zero for a fifth month, a sign that deflationary pressures continue to impede an economic recovery. Consumer price index rose 0.2% from a year earlier. That compares with an increase of 0.3% in May and a median forecast of 0.4% in a Bloomberg survey of economists. Companies rolling out promotions, again, what did we talk about? You put things on sale when the consumer demand isn't there, and then you stop producing more of the stuff you're having to put on sale. These are the very early things that we saw in the Great Depression. Companies rolling out promotions for the annual 618 shopping festival hurt the prices of entertainment-related consumer goods, household appliances, and cars last month. Factory gate prices remain stuck in deflation as they've been since late 2022, with the producer price index sliding 0.8% from a year earlier. The index declined 1.4% in May. China's economic recovery has been uneven this year, with manufacturing at times a bright spot, while consumption has been hampered by a prolonged real estate slump and weak job market. The problems related to deflation can be serious, potentially leading to a downward spiral as people hold off on purchases due to expectations. Prices will keep falling. This is a perfect example of some of these ivory tower economists that have no idea how the real world works. How many times have you made a decision on whether or not to buy something based on... I've been studying the macroeconomics of the situation, and I believe that if I hold off on that purchase, I can get a better price 6 months from now. No, what happens is people go, can we really afford to buy that right now? No, we can't. They go either, we're being prudent with our finances, or we don't care about our finances, but all the credit cards are maxed out and nobody else will lend us anything. So we can't buy that, so we won't. And when that happens, when enough people do that, then they hold off on the purchases until they're able to buy them later, right? That's what happens. That could dent overall consumption and spill over to businesses. The risk of deflation has not faded in China. Domestic demand remains weak, as Wei Zhang, chief economist at Pinpoint Asset Management, said. In the long term, China will need a rebound of domestic demand to drive the economy. Wo Chin Ho, an economist at United Overseas Bank, said that weak prices boost the odds of China easing monetary policy, including cuts to interest rates and the amount of money that banks must keep in reserve. And I want to point out, this can help ease things in the past, but you can cut interest rates all you want. But if people don't have the ability to take on more debt, they won't, no matter what the interest rate is. And as far as, well, they might cut bank reserve rates, right? let's focus on that one. Maybe if we lower the amount of the cash that the bank has to keep on hand, they'll have more to lend out, and then this indebtedness can continue and the party can go on, right? There's only one problem with that. And if you've been watching this channel for a while, you might know what that is. Bank reserve requirements can't be cut because they're at zero, right? And if you don't believe me, let's take a look at this right here. I know this isn't China, this is the United States, but this is straight from the Board of Governors of the Federal Reserve itself. It's one of their press releases. As announced on March 15th, 2020, the board reduced reserve requirement ratios to 0% effective March 26th, 2020. This action eliminated reserve requirements for all depository institutions. Banks in the United States, any Federal Reserve affiliated banks, are not required to hold a single penny in reserve for cash redemptions by depositors. Nothing. Zero. Now, this was in response to the pandemic shutdowns and the crisis we experienced in March 2020. So they've already played that card. So when they're saying, well, yeah, we might head into this deflationary spiral and this financial crisis, but they could cut reserve requirements and that could save the day. Now, they've already done that. Now, I'm not sure what China's are. It's sort of shadowy what's going on over there. But I would wager, if I wagered, which I don't, that they're pretty much the same, and all the other nations around the world are following the lead of the Federal Reserve on this one. And they don't require any reserves be held by their banks either, right? And even if they do, the United States currently sits astride the global financial system, and their banks say, nope, you don't need to have any reserve requirements at that bank. So when the irrational, inexplicable bank runs begin, there's nothing there to be given out, and they have to start selling assets. And as we've looked at in the past, in the United States alone, banking institutions are sitting on $600 billion in unrealized losses. Now, they get no problem, they're unrealized, right? But the moment those depositors say, give me my cash, those losses become realized and they wipe out those banks. And so we're entering this crisis. We've been talking about it on this channel for nonstop for almost 2 years. Many of you I know have listened, and that's a good thing because we're going to want to be prepared for this. I don't know when all of this happens, but all of this ends, well, or at least all of this is going to lead to, it won't end because this crisis is going to go on for quite some time. But what we're going to see as a result of all of this is we're going to see a bank holiday at some point. First, we've got China in this deflationary spiral. The rest of the world is going to follow along shortly. We saw a lot of things happening in the stock market last week. I'm going to continue to follow some of those. We did an update over the weekend over on the Substack. But we want to keep our eyes on that 10-year, 2-year yield curve, which is it's been spiking up recently. When that goes positive and stays there, we'll know that we're months at most, but maybe even days or maybe after the fact of a big market crash. We may be seeing the beginnings of the market crash already. We're going to see a stock market crash. We're going to see massive job losses. We're going to see a global depression that I believe we're already in, but it's going to become finally acknowledged. The news media won't be able to cover up for it anymore. And then at some point, the credit markets globally are going to freeze, meaning no institution's going to want to loan to another institution because they'll say, well, I don't want to loan you cash, and then I find out next week you're bankrupt. So they're not going to do that. And when that happens, the credit markets freeze. They'll shut down the banking system. They'll have a holiday again, just like they did in the Great Depression. When that happens, we're going to have a little bit of chaos there for probably a couple of weeks. I don't know how long that'll last. 3 days, 2 weeks, 3 weeks, I don't know. But everything runs on credit. Energy is what drives the global economy, but it can't function without credit either. Financially, the lifeblood of the economy is credit. It's what takes everything from farm to table. And so you're going to see whatever's at the restaurant, whatever's at the grocery store will be available once that bank holiday is declared. And then it won't be, because the trucks won't be running until the credit starts flowing again. So there will be a time where, you're going to want to prepare like a hurricane. If you live in a hurricane zone, and you're going to want to have food on hand, emergency supplies, whatever you think you might need, you're going to want to have on hand. So make sure you're preparing for that time now, because everybody that isn't preparing for that is going to be in a panic. And they're going to be suffering for those weeks as they figure out, well, I wasn't prepared for this. So make sure that you're prepared for that, because that looks like it's going to come sooner rather than later. I could be wrong. Maybe they'll kick the can down the road a little bit longer, but I don't think so. I think we're already starting to see these things take place in the markets. It's clear China is in that deflationary spiral right now. And so the rest of the world's going to follow shortly. So what do you think? Leave your comments below. Make sure to hit the like, share, subscribe, restack buttons. And God willing, I will see you on Wednesday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.